All right, guys. Well, welcome to this morning slash evening's webinar, depending on where you are. Hope that you get a little something from it. Thanks, Midhead. So, the previous couple times we outlined a couple trades that we could expect for the next few months. I don't know how many of you have attended my previous stuff. I think the most part, most. And we I think last time we talked about different fundamental cycles of things and where we are in reference to those in terms of who's prospectively raising interest rates, who's prospectively cutting interest rates, and then how to anticipate the price action slash fallout from that. Do you guys recall that? And then, in previous webinars, we've talked about different support and resistance price action and a couple of other things. So today, I want to talk about using historical information for the most part technically, but also fundamentally to try and help you predict the future. All right. Now, the beautiful thing about Forex, and I think this is the same for most other instruments, and please, guys, participation is important. Otherwise, I think I'm talking to myself. So the beautiful thing about Forex is that it's repetitive. All right. You see the same sort of things crop up over and over and over and over again. All right. It's a little bit like watching a baseball game, for instance. All right. And yes, you might see some different things on any given day, but principally it's a guy standing on a mound, a guy with a piece of maple bat in his hand, then a catcher and an umpire behind him, and a bunch of guys in the outfield all playing in different positions. You're going to see principally the same thing all the time. And Forex is no different. All right, now, it must be said, however, that recognizing these different things in the moment takes time, and that recognition takes time to master. All right, so because it's very easy, it's always very easy to look after the fact and think, oh well, shoulda, woulda, coulda. All right, but in the moment, can you recognize what the prevailing wisdom is? Okay, so I want to help with that a little bit today. And the cool thing is that from a technical standpoint, the repetition is on the charts. All right, we can see different things just by our historical information, and then try and put those in the context of where you were price action wise previously. All right, so I've written down a few little notes. So let's start with the fundamentals. All right, so how did we know that the euro stuff was going to get weak? How did we know that? And incidentally, we lined out like exactly a 143 short for the euro yen. We talked about euro Aussie getting short from sort of 154 area. It wasn't by accident, it was because we had a fundamental bias and then we went and searched for these things on the technicals, right? So what are some of the things that you can look for on fundamentally? All right. Now, there's one universal truth with fundamentals, and that is that yield drives the market, or rather said differently, the perception of changing yield will drive the market. Okay, so it's not even necessarily what interest rates are doing in the moment. It's what interest rates are prospectively going to be doing. All right, so we know, for example, that we are in, and this is just going to take some research on your part. Right, this just isn't going to fall in your lap, but, and this is going to be sort of oxymoronic too, is that there is a lot of opinion out there, okay? A lot. In fact, there are they're more than ever, I started trading, 2006? We're now middle of 2014. And when I first came on the scene, there were a lot less Forex literate folks. And obviously, as time's gone by and the market's expanded, there's a lot more experts out there, / analysts / whatever. All right. So there's a lot of opinion. There's a lot of resources on the internet. Be very careful just adopting a million different pieces of analysis from different folks, because it can be confusing and contradict things. So as much as you should take in other folks' work, yours is the best for your trading, because your internal clock and how you anticipate things, or rather how you anticipate things going for yourself, is the most important, because that's going to determine how you stay in trades and how your mind works within the does this make sense? For example, I'm pretty confident. I feel pretty good about the fact that the euro is on its way to about 115, 116. Okay. I'm also feeling pretty good about the fact that it's probably going to come back to somewhere in the 138 handle. And it's probably going to take 18 months to get to that level I'm talking about. Now, only I can determine whether I have the fortitude to, one, stay in that trade, two, rebuild the trade higher, how the money management for it's going to work, how my brain's going to internalize sort of staying in something for that long. Do I want to trade around that thesis? What would change it for me? Right? Only I can work that out. So taking somebody else's analysis and they say, oh, euro looks good to 132. When? In the next 2 weeks? In the next week? In the next 7 years? Are we going to go to 110 and then 150 and then we're going to settle at 132, in which case you're right. But you've gone bankrupt in between. Only you can work that out. All right. So I'll give you an example of the fundamental stuff here. All right. And you're going to see this, and I'm going to be quick because I reference this in other webinars. But let's look at something here real quick. Right. US, Aussie, pound, euro. Okay. And we got two components of things right now. We've got QE and we've got interest rates. So US, reducing QE, interest rates flat. Okay, and we'll, in this next little column here, we'll do sort of a 12-month expectation for it. Okay, Aussie right now. No QE, holding interest rates. Pound, holding QE, right? But they have quantitative easing and holding interest rates. Euro dollar or the Eurozone, no QE, or I say no, there is, but it's not in the formal fashion because of the ECB mandate that we see in the US and through the Bank of England, correct? And then obviously interest rates are settled low. But what is the wild card in the world at the moment? Wild card in the world at the moment is, are we going to see this for the euro? Are we going to see quantitative easing? And are these guys going to raise interest rates in 6 months? These guys here, the dollar, we're going to see the end of QE-ish, and then interest rates are going to be flat for a long time. They've told us that. And there's all sorts of speculation as to raising rates. It's a long way off. 12-month expectation, end of QE, flat interest rates, and we'll adjust as it comes. Aussie dollar, they've told us. RBA's told us they will be raising rates. Yes, oh, yeah, didn't mean to put the green there, obviously. They've been told us, look, we're probably going to have to do this in 6 months. And Mario Draghi came out in all his wisdom at the last meeting and said, yes, a currency that is strong mixed with deflation, although he keeps reiterating that the euro is not a priority for the European Central Bank. He has told us that a strong currency with deflation is not good. And he also told us in very plain English, which he never does, he's the consummate bureaucrat. He told us very plain English, yes, we will be acting at the next meeting. They told us. So which means this is going to... So can you see now that we have a disparity developing in the world? We have a perspective disparity developing here. This is obviously then will become sort of the crown jewel. This will become the red-headed stepchild. The US will sort of be sideways to maybe marginally bullish, and the pound is going to be lagging the dollar. Great. We've now worked out 12 months worth of fundamental bias. He's shown us that he's not the European Central Bank has shown us that they are very stubborn, if nothing else. But Germany was always sort of the crown jewel, right? Germany was always this beacon of hope. Strong employment, strong manufacturing, service sector strong. We saw good retail. All of it was good-ish in the context of what the European picture was. Now we're starting to see German data faltering. We saw the worst employment data, I think, in 5 years. When was it? 2 days ago. Right, so we're starting to see Germany like falter a little bit, and that to me is going to be alarm bells. But can you see here, guys, how we've worked out really fundamentally what's going on? David, what about the Kiwi? You're pretty closely related to the Aussie, but we've also seen a significant drop in milk prices. And believe it or not, milk prices have an effect on the Kiwi. All right, anyway. So fundamentally, that's where we are. So now we have sort of a game plan in mind. We have, say, Aussie dollar. 12-month, sort of 6 to 12-month picture would be neutral to up. Euro, Aussie, down. Pound, dollar, for the most part, sideways. Euro, pound, down. Okay, so we've worked out our little bias here very, very quickly. And once again, this is sort of a rudimentary look at for me, fundamentals. But this is really the picture. The central bankers tell you what they're going to do. If you take the time to read the minutes of their meetings, they tell you what they're going to do. They're not that... I think we give them way too much credit. These people aren't that smart. Right? They have many degrees, but they're just not that smart. All right, now, we can use this fundamental news and we can look at different technical things historically that can help us. All right, now, on a more day-to-day granular basis, if, for instance, there are just some things that we know, okay? If, for instance, it's a holiday in the US, there are those days where stuff can run, But is it likely to be a particularly good trading day, even in the European session? The answer is no, it's not. You might start out hot, but the chance of follow through just may not be there. Now, understand this, in a thin market, if something breaks, it can really run because there's nobody else to really take the other side. So if things are trading very thin and stuff breaks, don't try to challenge the other side of it in a thin market. Terrible mistake. Just get out the way and let it go. Come back the next day, go roast some marshmallows or whatever. All right, now, the other thing I want to talk about is I like to use stochastic cycles for things. And I don't necessarily use them to determine when stuff is going to turn around. Right? I use support and resistance for that. However, I like to use stochastics to filter out when not to go, even trading with my bias, when not to trade, when to be patient. And I'll give you an example. All right. Let's look at the euro pound, for instance. Okay, so here is a weekly euro pound chart. Okay, and if I zoom out here, we are obviously coming up against this resistance here, 81.60. Looks like a great place to short, right? Plenty of stuff here. Wonderful. Okay, so conventional wisdom here would tell me, hey, that's probably short. This weekly stochastic, although at the bottom, is still down. All right, but we have come up against nice support, like really good. And if I zoom out a touch, you can see what those levels meant. It's pretty legit. Okay, and then I look at the daily chart here. And look at these little stochastic. Incidentally, my settings here, whatever it's worth, 835. Now look at these, and you've got this little second cross here to the upside. So although we're coming up against this mega resistance, this is telling me that we are in a cycle of retracement despite my downside bias. So yes, I still believe that the euro pound is going to fall. Look at this monthly chart. This does not look bullish. This looks like this to me. Right? Because this is still the first wave here, and you're going to likely see something like that. But you talk about monthly here. You talk about 2 years probably of data. But yes, mid-70s, no problem. Okay? But then I go to this weekly chart, that's down. But I go to this daily chart, and we've come off serious support. But I see this happening. Strong into the trade zone on the upside. But my bias is down. So we're at resistance. So what do I think is likely to happen here? From experience, I know that when you've hit meaningful support like that, and the stochastics is cycled, if the stochastic was still down like this, and it made sort of a 2-day pullback, because it would still be down. This is just taking like 8 days, whatever it is. Then I know that I can trade off there, no problem, because I have it with me and I expect a lower high in continuation. But being that it's up like that, I know that it's probably wanting to go to the next level. It probably wants more like this zone. So yes, short term, you're going to see that. But then I expect it to bottom out and go to the next zone like this. And the stochastic will do something like that. And it'll look like it's rotated down, but it won't. It will straighten up again. Then you're going to get this sort of thing happen. Now you're in position for this to roll over. And on the weekly chart, that would have looked like it wants to cycle up, but then roll over again, just like it did here. and you're going to get that second bit of continuation, which on a weekly chart would be sort of 82 to, 79. So use your oscillators to help you. Another example. How are we doing on time? 8:20. You guys sticking with me? You bored yet? I know I always get like nitty gritty with you. Always try to like bring real applicable stuff that you can go and work with. Okay, so let's look at, say, a euro, for example. Okay, and more importantly, I'll drag down a dollar index chart. Right, what do we notice here? Mega area. Remember, the dollar index is 60% euro. It's essentially the reciprocal of the euro dollar. Okay, big time zone, correct? I don't know if you're a rocket surgeon to see that. Now let's look up here. Remember our fundamental bias. Draghi's told us that now if they disappoint at the next meeting, well, that could really make things weird. But he isn't. I doubt he will. All right, now let's look at the Swissy. And it all relates. All right, stick with me. All right, Swiss franc, weekly chart. Does this look like an important area? Yeah. Okay. However, this is still up. So what I'm trying to say is, is it a reasonable spot to see a real retracement of what we've had? Yes, it is. Okay. So something like this is to be expected. And then, something like, but if we relate that now to the euro, okay, why would I look at a dollar index chart and the Swissy chart? Because maybe the euro picture isn't as clear, but these other things correlate well. So I can use the correlation, support, and resistance to help me with maybe the pair that I'm willing to actively trade. Okay, so here's a weekly euro chart, and yes, we have come up against this stuff. It's important, but the euro is riding this thing downtown. Look at this weekly here. It weekly is saying the bias for like another month is down. Okay, daily chart kind of cycling on the bottom, but not bullish. But now let's look at the 4-hour. This is interesting. This is kind of in there. It's not, it's not into the trade zone, but we're trying to bite into a little bit. And with the next 4-hour close, it's going to be closer to this. All right. So the euro is telling me through that, it's saying, hey, here's resistance in the context of the down. Yeah, we probably want to go short there, but at the same time, this is going to be up here. And when it goes short, you're going to see sort of something like this, and then a step up while this has to cycle through. So I guess what I'm saying is the first wave here is probably not going to take it down because we're cycling up based on all the other support and resistance. And then you're going to see that kind of thing. So it's saying to me, look, take a trade around 36.60. Take a trade around 36.80, 37, 37.20. But don't load the boat on this one. Build the sucker a little bit. Build it here, build it there. If it notches up one more, great. Then it's going to be ready to go down. The daily isn't bullish. The weekly is still bearish. Then I'm going to be all lined up. But it's telling me, hey, it's probably only going to drop in about 36 to 48 hours. Why? Because of the way things are cycling and where it's coming off support. And yes, there is an experience component here, but you can use these oscillators to help you time those things. Does this make sense? Now, bear in mind, it's a slow news week. We're getting to Friday. Not really. No. I'm more of a take a bias, pick a level, be happy. So I look at this euro and I look at the weekly and I think, okay, well, something three here, something three here, something down here. That's an interesting and involved question. Um, what do I think in moving averages? You see, moving averages are laggy, one. Two, they will tell you, hey, Kevin, they'll tell you different things on different time frames. Give you an example. I like to use this little envelope for this, and I want to get to something very specific after this. I'm going to hustle through this question, okay? If I don't catch it in more detail, I'm happy to do a full moving average thing next time. All right, so this looks gimmicky. All right, this is my little envelope. It's like I think the moving averages are five deviations apart, so like or 10. So say 90, 80, 70, and then you'll get to like 65, 60, 55, 50, etc., all the way up to like 10, I believe. All right. But it's you can see just visually when prices rolling over, right? When things are transitioning. Okay. And you can see when here the envelope is fully established to the upside. Here we are getting established, but we're not. And if you look at it on the weekly, I bet it's full up. Very much so. Very, very much so, right? And you're also into this mega sport. So here, this is saying, great, we've been riding the quick moving averages. We want to dip into the lower stuff based on the resistance. Great. So this is saying, hey, we're probably going to do something like that. All right. And then you look at the daily and you're like, well, hang on a minute, it's rolling over. 4 hours rolled over. Yes. But the weekly's told us, so the weekly's telling us 133, 132. The daily and the 4 hour are basically educating us on how we're going to get there. So this is saying, hey, we're riding a quick moving average. Yeah, we'll probably extend from a little bit, then come back into it as it drifts down, and then cruise down to that weekly level before then basing out and doing that move to 147. Just because I think largely just because of the amounts of resistance. Yeah, I'll show you what I mean. Look at he has a monthly now. All right. Very significant level here. But look at the distance, look at this thing. It's telling us that we're probably going to see something that is more of a real swing, so to speak, not just one of these, return to the quick moving average. This is the first time that we've broken this 5 EMA. So the next level to that would be the 21. And although the 21 EMA here in orange is at 130, you got to realize that it's dynamic. So when it's actually meeting price, it's probably getting to be close to 132. Okay, and you can see just the distance that price got from this moving average. These distances repeat. Okay, look, you can't measure the bearish side because different bearish markets behave differently, particularly on the yens to bullish ones. So let's take this measurement here at its extreme level to the distance to that 21 EMA. And I bet you that at its extreme, you'll see that these distances repeat. Your point is what, Boyke? Where are you going with that? Can you see how these repeat? I'm doing that right now. I'm showing you how I'm showing you how historical information will help you predict the future. Okay? So it's a compelling point that these distances repeat. Can you see that? And here we are at the same sort of level. So it would be killing me there, Smalls. Killing me. So it would stand to reason here, also given the price action that we want to do sort of something like this. Makes sense? Weekly down. All right. Does that? I know that is a very sort of brief look at moving averages, but you always got to look at them within the context of the time frame, and then try and sort of extrapolate that forward as to right, we're down on the daily, down on the 4 hour, but up on the weekly. Great. So has the price action changed? Yeah, it's changed. Great. So we're going to go to the next level in the context of the weekly. How is that going to happen? You can use the moving averages to help you do that. All right. So here's what I like to do sometimes. A lot, actually. All right. Here's a Euro Aussie. We've established how do you reckon past this data and new changes? Well, you're using everything within the context of what your fundamental bias is today. Thanks, Kevin. Will do. Okay. So here's what I wanted to point out. If we look at Euro Aussie here, all right, and we've talked about a bearish fundamental bias here for a multitude of reasons. All right, and just visually we can see, hey, we've hit significant little level here at 45 and change. All right, and then the next zone is clearly 43. But fundamentally, I'm a bear. That can change, but I like to trade in one direction. One. If I'm a bear, I will just wait for shorts. If I'm a bull, I will wait to be bullish. Okay. So if we're looking at an example like this, what I like to do is think about, hey, how did a bounce in an area like this work out in previous occasions? What did it look like? Right, so I look at something like this and I say, okay, well, 45.60 was pretty good support. My next level is 43. We are now staring 46 and change down the barrel. This is cycled down, but this isn't a great area to short. And then I go back and look at it and say, right, what have we done historically? Well, this looks pretty similar. This was an uptrend, hit an area of resistance, came back, sort of made this little base out, and then came back to the resistance here, and we made this fib of that rise. And at the time that we would have hit that, the stochastic would have been down here. This looks pretty similar to what we've done here, just on the other side of it. Here's our little top out, the same as these bottoms prospectively. The bias is now turned down. We know that our next major level is 43, and we know we're coming off resistance, is what this did. So I'm expecting I'm basically expecting this here. So I can plan around that. I can happily plan around that. So let's look at, say, a 4 hour, for instance. Okay, here's our 4 hour. So I'm expecting something like this. Hey, here's resistance. Here's support, lots of it. And here's sort of a cluster of price. Would it be reasonable for us to see this? I think so. One, it's with our bias. And then two, it's happened historically. I'll go back to this daily chart. This is the same sort of thing that we got here. And this is the same sort of thing as we got here. It looks identical. Okay. And that's the same sort of thing as we've got here. You with me? So like we ironed out the so should we look at, we have 9 minutes left. Let's look at, but funnies can be different, absolutely. But it takes, like, the fundamental cycles like 6 months to a year. I think that we slap bang in the middle of it. If anything, we're in the first 35% of the fundamental cycle of this trade. I don't know if you caught the beginning of the session, but we talked extensively about that. Yeah, I mean, the ECB is just starting to entertain real quantitative easing in the true sense of the word. The Australians have told us, hey, we're probably going to be raising rates in 6 months. Those are going in completely divergent directions. One's fighting deflation, the other guys are going, well, hang on. Our housing market's hard. Okay, so let's look at, for argument's sake, I don't know. Let's look at pound Aussie. Okay. Just because we can. So it's not a Euro Aussie situation, but I would also say that fundamentally the pound is probably a touch weaker, contextually speaking, than the Aussie. So fundamentally, I am not crazy bearish, but I am principally bearish on this, fundamentally speaking. All right, now we can go to a chart and have a look. First thing I notice, okay, that's up. Oh, hello, this is a very contentious area. All right, and if I zoom out to, that's as much data as I can fit on here. This is unfortunate. I could probably pull up a different. Now I'm a little bit blind today. Anyway, this will work. There it is. Excuse me. Okay, so here we go. Here's pound Aussie. All right, now, sorry guys, I'm just trying to get it lined out. I don't want to use like, I mean, let's use something that pushes us a little bit. Okay, so couple little bit of resistance here. This is obviously a significant area, isn't it? Very. All right, now, what I want to point out too is this. Was this sort of extremely overbought? It's interesting, it's coming off the cycle level too. I mean, I think it was decently overbought. Don't look at the, how deep into that overbought area you've gone. It means nothing. All right, but let's have a look here. Weekly. Give us a little more sort of something a little more applicable here. All right. Does this look like a great level to short? Probably not. Does it look like a phenomenal level to buy? No. Because we've worked out that we're coming off this. Okay? And something off that amount of support, or in this case resistance, should precipitate at least a 30% pullback. Because this is a major level of resistance. You don't get many of them. Look, in the last 20 years, you've had 1, 2, 3. We've created 4 levels. 5, 6. So in 20 years, there's 6 major levels. Okay, this one. This one. This one, obviously, which has been created now. And then this one here. And this one. So I stand corrected. 1, 2, 3, 4, 5, essentially, because this is 6. So, all right. So something of a significant area like this should give you at least a 30% pullback. We just know that through experience. We know when you hit major, like, multi-decade areas of support is that you're probably going to pull back or bounce 30, 40%. And it just happens the fundamentals are queuing up to agree with it. Then we go look more on the weekly and we say, okay, well, hang on. What did we do around this area before? And you can even measure this sort of move. Oops. And say, well, okay, we got that kind of bounce out of it. What's that going to look like? Oh, all right. That gives us a reasonable looking target. Right? 169.50, we'll call it 170 for argument's sake. If we just take that down a little bit, hey, there's conveniently an area of support below that. Right, so then we can cruise to our daily chart and start building the plan around what we've seen historically. So weekly down, stochastically, daily, weekly up, stochastically, daily down. Support. You can draw a line here even. So what's this telling us? Probably going to see sort of something like this develop. Why is it going to cycle down the second notch? Because this daily is down. The weekly is on its way up. So you're going to see sort of a second wave relative to the daily. I just know this because I've seen it 50,000 times. It's the same contextually as sort of something like this. The daily would be in the same spot when this is here. The identical sort of scenario, except for this was in the context of a bullish market. I'm just demonstrating how that sort of flows together. So here, And then you'd like to see sort of something like this as the daily cycles up again in the context of the weekly and then rolls over. So the interesting thing here is going to be, hey, when I'm sort of at this support zone, pound is probably going to be a pretty good buy. And then you can start building that too on the cross correlation as far as, where is pound low? 164. Okay. They've 300 pips on the upside. So I am going to wait for this trade, a 180, 180.20 short. It's not going to make a ton, but it's significant. And then I'm going to wait for this one. Why? Because it's in the context of a bias and using that overall resistance. This is a massive sort of 1, 2, 3 pattern. That is 1,500 pips. Starting to make sense? All right, guys. Well, I hope you got something out of this webinar. And good luck further. We'll see you next time. Cheers. Guys, if you want to reach me at Forex David on the Twit. There you go. All right, guys. Thanks. We'll talk to you soon.